Foreign institutional investors, or FIIs, have long been one of the biggest forces on Dalal Street. They have dictated short-term market momentum, influenced large-cap valuations, and often shaped investor sentiment. But today, they are no longer the biggest owners of Indian equities. Instead, for the first time on record, domestic institutional investors, or DIIs, have overtaken them in ownership of the Nifty 500, marking one of the biggest structural changes in the history of Dalal Street. So what has fueled this shift in power? According to Motilal Oswal Financial Services, DIIs now own 21% of the Nifty 500, the highest ever, based on shareholding data as of June 2026. FIIs in comparison hold 17%. This is the culmination of 9 consecutive quarters of rising domestic ownership, signaling a structural change in how India's stock market is funded. Over the past 22 months, domestic investors poured in $166 billion. In that same window, foreign investors pulled out $58 billion. A major contributor has been systematic investment plans, or SIPs. Monthly SIP inflows have averaged around $3 billion, creating a consistent source of liquidity for the market. That has helped cushion Indian equities during periods of foreign selling and reduce the market's dependence on overseas capital. Now, the buying is not limited to a few large stocks. Over the past year, DIIs increased their holdings in 73% of the companies in the Nifty 500. FIIs, meanwhile, reduced their stakes in 59% of the index. The trend is even stronger in the Nifty 50, where domestic institutions increased holdings in 82% of companies, while FIIs reduced exposure in 72%. DII ownership has also touched record highs across large cap, mid cap, and small cap stocks, showing that domestic buying is broad-based. Domestic investors have increased holdings in 19 of the 24 sectors in the Nifty 500. The biggest increases came in private banks, telecom, real estate, technology, healthcare, insurance, automobiles, PSU banks, NBFCs, retail, and capital goods. Foreign investors, meanwhile, reduced exposure across 19 sectors. They selectively increased investments only in metals, PSU banks, NBFCs, capital goods, and logistics. Even though ownership trends are changing, one sector remains the top choice for both investor groups: banking, financial services, and insurance, or BFSI. It accounts for 34.6% of FII allocations and a record 29.4% of DII allocations. Now, this shift does not mean foreign investors have become irrelevant. They still play an important role in Indian markets, but the balance of power is changing. With strong mutual fund participation and steady SIP inflows, India's stock market is now becoming driven by domestic savings rather than overseas capital, and that could make the market more resilient during periods of global uncertainty. Follow Business Standard for more stories.